This is why I don't buy commercial property in Southern California. For those of you who don't know who I am, my name is Matthew, commercial deal junkie. I'm a commercial real estate investor and broker based out of Southern California, but I buy commercial property all over the country. Commercial property in Texas, Florida, Ohio, but I don't buy anything in California, and I'm about to tell you exactly why I don't. Now, I was going to create a bunch of slides about rules and regulations and cap rates, but I just decided the easiest way for me to show this and demonstrate what I'm talking about is first literally just to scroll through LoopNet and look at the opportunities that are available around where I live. Now, obviously, the saying is LoopNet is where properties go to die. But honestly, that hasn't been my experience. Usually, if I find a property and I can, offer 20% less and then I can start the conversation on LoopNet and we do that. But so this is Southern California right here, like, Anaheim, Pomona, Whittier, Norwalk, Santa Ana, Irvine. This is like, around where I live. And just scrolling through these here, before we deep dive a specific deal, the first thing I want you to notice is the price points. Peters Landing, 51 million. This Pomona Shopping Center. So this is specifically shopping centers because that's what I'm currently buying in this market cycle. 15 million, 16 million. This is a tiny 5,700 square foot building selling at, 1.8 million. So things here routinely sell three, four, $500 a square foot. So you're paying typically above replacement cost. Maybe when you factor in the land, maybe not above replacement cost. But we're talking about like an older building here selling at three, $400 a square foot. And that's the problem with Southern California is because there's so many buyers, it drops down the cap rate. So number one, you have really high price points. So if you're looking to buy in the 1, 2, 3, 4 million range, it's really hard to buy something in California unless you're going to buy something really tiny. That's the first thing. The price points are just too high. So that's a fancy way of me saying that I'm too poor to purchase commercial real estate in Southern California. But that's not the only problem. Price points are high. But the second thing I want you to notice here is look at these cap rates. 6.82, $51 million deal, maybe already stabilized, maybe has some, the boat slips are probably what's bringing up that cap rate here. Boat slips tend to rent at a higher cap rate. Six cap, 5.7, 5.53, 5.5. So generally cap rates here in Southern California, they're between 4.5 and 6.5. At 6.5 probably means, there's, maybe marijuana tenants and maybe you have a bunch of mom and pops with very short leases left, maybe a triple net tenant that's about to expire. So if something's at a 6.5 cap in Southern California, that means there's hair on the deal for sure. But typically you're going to see the 5.5 cap range, which means you're negative leverage. Now, negative leverage is a fancy way of saying that your debt is going to cost you more than what you're making in your cap rate. As a result, the more leverage you have, the worse the deal. So it's incredibly hard to get things to pencil here. So you have low cap rates. I mean, here's a 7,000 square foot building for 500. I mean, let's pull this up. Santa Ana, California, $757 a square foot. Like that is insane. And this is an old building. I mean, what year is this? This is crazy. A 1969 building and you're paying $757 a square foot. Like honestly, I guess if you're, California works well for long-term buyers and cash buyers. Those are the two that do well here. And there's a lot of liquidity. So there's a lot of people with money in Southern California. So if someone's going to come in, buy this cash, enjoy, instead of putting their money in a high yield savings account where they're going to get three or a bonds where they're going to get four, they purchase this building, they get 5.25%, probably triple net leases. If not, you can convert them to triple net. These are like local tenants. I mean, you got a liquor store, you got a beauty salon. Like these are not credit tenants. You could buy a Starbucks in Houston, Texas at a six cap. So like, I don't know why anyone would buy C class building with C class tenants at a 5.25 cap. Like it doesn't make sense to me. It doesn't register with me. And I'm a broker here in Southern California as well. So I do transactions. So I help people sell and buy these properties. And even though it doesn't make sense to me, there are buyers out there. Maybe not at this price point because this is insane. $757 a square foot is an absolutely insane price. But there are buyers out there. But look, I mean, this is an eight cap, but I guarantee you there's hair on this deal. Let's see why this one's an eight cap. I'm looking at this for the first time, so let's just see what's going on. Well, this is a court ordered sale. This is probably the starting price of the court ordered sale. and it'll probably get bid up to a higher price. So that's why that one's at that cap rate. But let me tell you a story here. So I found a retail strip center, 6,000 square foot in Anaheim, California. And I was excited because it was actually listed at a reasonable price. It was listed at $200 a square foot, had a bunch of mom and pop tenants. Cap rate was really low because the tenants were paying pretty much nothing and they were on gross rents. So the landlord was paying all utilities, insurance, property taxes out of pocket, but it had value add potential. This thing was listed for 2 million. My plan was to, buy it for 2 million, put a couple 100,000 in it, lease it up, clean it out, and then it'd be worth 3.5. Perfect deal. So I go in, I make an offer for 2.2 million, 200,000 above asking. Okay. And I was like, this is going to be my first Southern California deal. Very excited. Financing contingency, inspection contingency, the normal contingencies I go under contract with. Next thing you know, send the offer in, crickets. A week later, I call him and I was like, hey, what's going on? Like, was our offer accepted? Was it declined? The expiration date on our contract is, he's like, the property ended up selling for 2.7 million, all cash, no contingency. So what does this mean? The Southern California real estate market is very, very efficient. Even when something is listed below value, below market, there's enough buyers that it drives the price up. There's enough bidding. It drives the price up to market value. And I like to purchase stuff below value, stabilize it, value add, and it's worth more. That is incredibly hard to do in Southern California because of the amount of buyers, because of the amount of liquidity. Now, when you combine that, the amount of buyers with the lower cap rates, with the extremely high price points, and now on top of that, stack regulation. There's so much regulation here, especially in the multifamily space, and people tend to harp specifically on the multifamily space, but even in the commercial space, in the retail and industrial, permits take forever. There's so much red tape when it comes to the different permitting and tenants getting certificate of occupancy. It's difficult to be an investor here. Number one, you need a lot of money. You need a lot of patience to deal with the municipalities. You need to be willing to pay market price. It's very hard to get stuff below market here. Now, to counter that, some people make a lot of money by going off market, contacting owners directly. But typically, you're not, incredibly difficult to find a strip center here less than 3, 4 million. And even when you do, there's a whole bunch of buyers. So those are like the big reasons why I haven't been able to invest in Southern California. And literally just a couple minutes scrolling on LoopNet here. The only things below 5 million are tiny little strip centers, 7,000, 5,000 square feet, little strip centers. Now, obviously people out there have been making money in Southern California. Obviously, people are out there and they're still finding ways to make money. If they're local, then they can get creative and find better tenants and improve the building and chargers. And people are getting really creative on how to make money here in Southern California. But at this point in my investment career, first barrier being I can't afford it. The price points are so high. And then after that, once you stack regulations and cap rates and how many buyers there are, so it's really hard for me to get something at a good price, a price where I can actually make some money. I've opted out of the Southern California market. It doesn't mean I'm not looking. I'm always looking in this market, especially as a broker. So I'm looking for clients that are looking to purchase a deal, or maybe I'm working with a client that's selling the property. So I'm looking at comps. So I'm always looking here in the Southern California market. But other than that one property in Anaheim, I have not found many deals that feel comfortable putting in an offer on. So that's kind of like my rant why I haven't been buying in Southern California. Doesn't mean you can't make money here. Like there are people that maybe there are other parts of California here. Like if you go into Bakersfield or like this middle California here, it's a lot easier to make money. Obviously, once you get into the San Francisco, Sacramento market, you start running into the same issues you run into with Southern California. Obviously, San Diego is also very expensive. So it really depends on, you could go to the tertiary markets here in California and make some money. But as far as the major California metros, it is incredibly difficult. You're literally playing the game on hard mode. And then I think about commercial is a lot easier to own long distance. So owning a shopping center in Houston, Texas for me isn't difficult because the tenants are on triple net leases. They take care of their own repairs. They take care of the property maintenance and the insurance and the taxes. I get the tenant in and they essentially run their business out of there and make their money from my shopping. So there's no incentive for me not to go long distance. Now, if you're in the residential space or in the multifamily space, especially small multifamily, it's a lot harder to own those long distance because you're responsible for all the maintenance and all that. But still, you can get local property management. So if you're in a hot market, not necessarily just Southern California, if you're in New York, if you're in New Jersey, if you're in Austin, Texas, if you're looking to get started, get your first deal, your first couple deals, commercial offers you the luxury of investing long distance and looking for assets all over the country. It can be a little overwhelming because there's so many markets when you look at the country as a whole, but you can look out there, you can find deals with much better yield, deals where you can actually add value at lower price points and you can make some good money. Anyway, I hope you guys enjoyed my little rant here about investing in hot markets or heavily occupied markets. Like, subscribe, do all that stuff, and I will catch you guys on the next video.